Successful investing is about identifying trends before they emerge and identifying the changes that bring in new winners in the market. As if it was really that simple, right? Why are we sitting here in this room even kind of trying to figure this out? This year is filled with uncertainties, and you obviously got a snapshot, a view of that in the panels before us. You have a new administration in the US. You have a lot of uncertainty coming in from what's going to happen on the fiscal front, on the regulatory side, on trade, on immigration. There's just so much to answer. If there's one person in this room who can put their hand to their heart and say, I have a very high conviction on where this is going, I would love to meet you after the panel. And as if the macro was not muddled enough, you had DeepSeek basically putting the whole AI bubble to test. So we have a lot to cover today. And ladies and gentlemen, please put on your figurative seatbelts and get ready for the ride, because the one risk you're carrying is you snooze, you lose. Yeah. Thank you so much for joining us today. Without much ado, let's get into the macro view first. Jay, let me start with you.
Yep.
We've talked about all these risk factors that every investor in the market right now is facing. How are you positioning your portfolios to manage these risks?
All right, so we take that the baseline is that the U.S. economy is healthy, solid, strong, that inflation is coming down, and that the Fed is going to be able to cut interest rates a little bit this year, but probably not a lot. So I think there's one or two priced in. So that's the baseline. The catch is that around that, as we've been talking about, are a whole bunch of uncertainty and variables. So it's a pretty wide swath that we can go through. One thing we can say is that we do feel best about the U.S. economy overall. Don't feel quite as good about Europe and some of the changes and issues that are happening there. And we'll get later into assets in these areas. But the baseline is things are going good in the U.S., but a lot of uncertainty.
Yeah, I think it was quite interesting to see some of the companies that I cover based out of Europe wanting to list in the U.S. And you were talking about commentary on Davos, right? A lot of CEOs hoping that they were headquartered out of the U.S.
I wasn't at Davos, but the number of people that I talked to were there, threw that out as an anecdote, that they were talking to some European CEO who was saying, you know, it's a struggle here. God, I wish we were listed in the U.S. I mean, valuations are higher. Seems to be easier to do business. I think that's the thing that's positive about the United States, is it is easier to do business, easier to innovate.
Absolutely. And of course, the liquidity, right? That is the one key metric that all of us are kind of watching. And Emily, let me draw you in on that.
Sure.
Especially on the venture side. Like, we had quite an interesting year last year.
We did.
And obviously, there's so much noise, so much liquidity tracking, all sorts of interesting assets on the private equities, on the venture capital side. How do you zero in and navigate that landscape? And like, especially when you're reviewing investment opportunities.
Yeah, absolutely. I think that's a great question. I think it'll play nicely off of what Jay was just saying. Let's take it in two parts, right? Let's talk about the liquidity, and then let's talk about how we're investing, right? So 2024 was a very interesting year, as you said, right? It was all about corporate venture, and it was all about AI, right? So corporate venture year over year was up 20%. The majority of their investments at a tune of 37% were in AI. Right? Not surprising, right? And then, as Jay was pointing out, right, the majority were in the U.S., right? I think it's really important to say. I think this trend is actually going to continue. What I do think that we're going to see in 2025 is we've got to return that capital back to the investor, right? And I think that's incredibly important. We don't want to lose that point, because there's a lot of capital out there. People want to make investments, but they need that capital to return, right? So I think that's important to acknowledge. And then from an investment side of how we're making investments, right, the way that we do it at IBM is a capital plus model, right? And if we continue to look at how CVCs are going to continue to control it, you've got to look at the strategy behind it and what you're investing in, right? And the way that we do it is we do that plus, which is adding that additional value and that differentiation, which is, you know, going to market together, collaborating technical expertise, and then getting back innovation, insights, trends, like all the stuff we're talking about now. It's huge.
Absolutely. Alan, we had an excellent chat off stage, but I really want you to share what are some of the top investment ideas that you are kind of recommending in this market.
Well, I think Jay's great point. We love the U.S. And when you think about the U.S. market from a free cash flow yield perspective, from a free cash flow growth perspective, and really in spite of high valuations, we see it as the best house in a bad neighborhood of equities across the board. And yes, you may see lower valuations in Europe and parts of Asia, But the bottom line is we sport higher valuations for a reason. And so we think that both large caps can do well, but also mid caps, because in the mid cap space, you have a little bit more growth, a little more juice there with not quite the same valuation levels that we're seeing, particularly in large cap tech. And so we see that as an opportunity as well, particularly in light of that relative value versus large cap.
Absolutely. And I think there's another element of supply chains within the small mid-cap space. We'll come back to that, though. Yep. But Jay, Alan's talking about U.S. exceptionalism.
Yep.
What are the drivers that you're seeing within the U.S. equities right now? What is attractive to you, and what are you watching?
So, I mean, what's attractive is, again, the operating environment in the U.S. enables companies to be innovative and creative and kind of expand and create new markets, but also maintain profitability, have flexibility in terms of managing their workforce. All these things are things that differentiate the U.S. from a lot of other countries and regions. I will say that I think valuations are pretty high in the U.S., and there's a lot of good outcomes priced in there. That's uniquely kind of a U.S. thing. I think outside of the U.S., valuations are more attractive. But I think what we see happening is that in the U.S., it might be priced for everything to go right. Outside of the U.S., it's kind of priced for everything to go wrong. We are pretty confident that the U.S. companies will have stronger earnings growth, probably with stronger returns on investments than Europe and some other areas. The question is how much of that is priced in and how much is priced out of some of the other areas. And I think that's where the kind of the uncertainty lies, and where the opportunity is to make good choices, to dig deep, and to find the great opportunities.
And I think one thing I'd love to point out is also the strength in the dollar. I think that's some force that we kind of have to keep in the back of our mind when we are considering international equities. Mm-hmm. So, Alan, dialing into your U.S. equities preference, what are you thinking from a sectoral lens? Are we looking at a rotation trade? Like, what are you kind of thinking about tech versus whatever? And we will get into tech more detail, but like, what's the view there?
Certainly. So we still like communication services. We think despite the rally last year and the year before, we think it can continue to do well. We like financials, particularly in light of where the yield curve is, as well as the deregulation play and what we're seeing with the new administration. And then finally, we like the idea of industrials and the opportunity says you think about this infrastructure in spend, and I think Ernie alluded to it earlier, but just this broad global infrastructure spending that we think is going to occur. It's not just on the tech side, it's on the hardcore old sector of industrials, and we think that's an opportunity.
Absolutely. But I think one of the key challenges that any and every equity investor has faced last year is, what do you do with Mag 7? Every single time it's like, oh, it is too expensive. Do I buy now? Do I buy now? And admittedly, that is one challenge that I personally have faced last year through and through, and have had to play along, right? So it's almost imperative, even if you aren't traditionally a tech investor, to really understand the drivers within that space. And it's very hard to just go in and say, okay, this is something AI. We really need to start doing a little bit more homework in that sector, just where Mag 7 has reached, right? So I wanted to leverage that opportunity to bring in you, Emily. Like, what are some of the broader trends that you are seeing within tech that we should be watching out for 2025?
Yeah, I think, like Alan and Jay have alluded to this a little bit, I'll talk more about it, is the structure of deals and the creativity around the structure of deals, and we'll talk more about that. I also think, Christina started talking about this in the previous panel, but we got to acknowledge DeepSeek, right, and everything that they're doing there, right? And I think from an IBM perspective, right, it was beneficial to us because it proved that you don't need large proprietary systems, right? Smaller, fit-for-purpose, open source models are going to be successful, right? And for us, the lesson is it's about optimizing. It's about optimizing performance, about optimizing cost, right? And that's exciting for engineers to go solve, right? For IBM, we have seen 30% reductions using this with inferencing costs, right? And so we've got to challenge ourselves, and we have to think about, why are we paying huge amounts? Why do we need massive data centers? Why do we think that inferencing and training is fixed, right? So we have to ask ourselves these questions as we look at these large trends. It's an opportunity for startups to get after this, right? It's an opportunity for them to push costs down, to make it widespread. And I think as we think about where our clients want to be, we've got to make sure that when we bring and we talk about these transformative technologies, they've got to be affordable and they have to be accessible for our clients.
So that is another interesting deja vu moment for me. When cloud came in, everyone saw this massive rush to the public cloud.
Yes.
And then people got their bills. And then we started having a conversation. Okay, how do we kind of manage that now?
Yes.
Do we really need that much compute power or storage or flexibility, so to say? So I think that's a very interesting point, even with like what the DeepSeek moment kind of, and we will go in a little bit more into that.
Yep.
But coming back to the Mag 7J, what do we do this year?
Well, look, I work with bigger picture clients and bigger picture portfolios. It's tough to decide what to do with the Mag 7 and whether to overweight it or underweight it or those kind of things. And honestly, in the short term, we don't think you should be trying to make that call. Kind of the market cap weights are a very reasonable place to be. When you dig in and look at the valuations and essentially the expected growth from the Mag 7, it's not off the charts. They don't need to achieve what they've achieved the last couple of years in order to earn a reasonable return on these investments. In fact, they could even slow down a little bit in terms of their earnings growth. So it's not crazy to think that the Mag 7 can earn a decent return. It may be a little crazy to think it's going to earn another 30% or 40% going forward from here, but a nice upper single-digit return is within the realm of possibility.
Yeah, I think for me, the bigger question is the multiple more than earnings growth. And what was really interesting is if you looked at the CapEx numbers that came out of Meta versus Google and the reaction there, I think that was really fascinating, like just the stock price reaction to that. So, Emily, obviously we're seeing this nervousness build up around AI, right, in the market. Would you call it a bubble? And is it a bubble?
Okay, well, look, I've all read the articles, right, that we've all been looking at, and we've all read the markets and looked at it. And no, I don't think it's a bubble, or at least not yet, right? And for me, the biggest thing is do due diligence. Do strategic due diligence in the sense, are they aligning with your missions and your goals? Do technical due diligence. And we'll talk a little bit about this later. But if you do your due diligence and you make smart investments, you're going to see returns, right? And as long as they align. So I think that's really important to making sure that you do that.
So where are the next opportunities in monetizing AI? If you say it's not a bubble, where do we see the next leg come from? We've seen the NVIDIAs of the world kind of reflect that, but
I think it's some of the things we just talked about when we use the DeepSeek. It's, are you able to optimize costs? Are you able to optimize performance, right? I'm already collaborating with a lot of companies that are doing this, and they're doing it at the research level. We're going to talk about quantum. I like the way that quantum looks in the next few years. I would say closer to 2 to 3 years versus 5 to 7, right? Agentic is going to be another thing that's really interesting.
No, but staying on to AI, where do you see the next monetization happen? How about the broader adoption levels?
Yeah, it's about productivity, right? It's about cost savings, right? So it's like all of the things I just mentioned are opportunities to actually create productivity, therefore cost savings across your enterprise.
And where are we right now?
And I would say we're at the very early innings, right? The very early innings. We at IBM have used ourselves as client zero. We're now bringing those to our clients. But I think what's really interesting, if I'm just going to give you a quick stat, 80% of enterprises are doing POCs in AI. Only less than 10%, right? Think of these numbers, have a strategy to bring AI to the enterprise.
So that brings point to the point of the rotation that we were just talking about, right? Like the benefits will start accruing to other sectors in some form or ways. Alan, do you think that DeepSeek sowed the seeds of what will burst the AI bubble? I will still call it that because there's just so much nervousness.
And you can disagree with me.
No, I think the reality is that it may not have sown the seeds of popping the bubble, but what it did is reframe the conversation and moved it from it's going to cost $75 billion to $6 million. Yeah. And what I believe is it's going to be somewhere in the middle. And we keep looking at it as it's somewhere in between. Yeah. I don't think anyone has a real sense yet of what that number is going to be. Yeah. But it's actually exciting. And I think about waking up that morning, reading the news about DeepSeek. Everyone is freaking out. Market sells off. At least the equity markets sell off. Everyone's in fear of what that may mean. And I'm thinking, wow, this could be great. Think how much from a productivity perspective.
Yes.
Think how you can accrue that benefit to at a corporate level.
Absolutely.
If you can implement this. So I think that's that transition of people saying, okay, could we do it for less? What does that constitute? Yeah. And even then extrapolate that out to utilities. There's been, utilities are the new growth story. Absolutely. So is that still the case if we don't have to build, the data centers that are currently being forecasted? Yeah. I think we will have to do more than less, but I think that's the interesting conversation around DeepSeek and AI.
But that's what's so important, right, is the idea. It's like people are being asked to constantly do more. And it's like, to what point, right? If you don't interject AI and you don't get those productivity gains, it's like you're never going to get to where you want to be.
Yeah. Oh, and by the way, if you don't have the silvering of the globe on a demographic level, on global scale of aging populations, lower immigration, you've got to have productivity. You've got to actually insert a level of
Well,
productivity.
we can balance that conversation with all the job cuts that we've seen recently. Right? And
We don't need to get into that now.
Right.
But
This is such an over-discussed topic
Yes.
that I think I'd rather not go there. But I think
Yes.
for me, DeepSeek was very interesting because it kind of showed the amount of volatility that we can expect with these kind of events.
Yep.
And what is underlying this whole reaction is that some of these valuations are just priced to perfection. So if you have any such incident coming in, and we might see more of those this year, you have to be prepared for that volatility. So I think that really was interesting. I mean, AI obviously gave the next leg to your NVIDIA story, and like you saw, whatever happened in the last 2 years. But beyond the hype, what are the other emerging technologies? You mentioned quantum.
Yep.
Can you talk a little bit more about what are the 2-3 other things that are not on the radar right now, but could be?
Look, I think quantum is one of them, right? And I think quantum is going to be here sooner than you think, right? So quantum advantage, I think, is going to be here in the next several years, right? And for me, what I'm looking at when I go to invest in a quantum company, I'm looking at software companies that are going to build on hardware. There's really good hardware out there, right? And we've talked a little, other people have mentioned quantum, right? But they're getting after the medical space, right? They're getting after the chemical space. They're getting after batteries. There's so many interesting use cases. And I think in the future, right, how are quantum and AI going to play together? That's going to be really interesting. And developing those use cases and balancing the hardware and the software is going to be really interesting, right? I think the other thing is agentic, right? We talked a little bit about, right? Agentic technology is getting there. The question is going to be for the enterprise, how much are you willing to use it? Are you going to want to keep the human in the loop? Do you want to take the human out of the loop, right? That's going to be a fascinating conversation at the enterprise level. And then I think security in general. I love security. I love AI for security. They're really willing to lean in, right? But they're also both on the security function in the business as well as AI startups for security, right? They are really, really embracing the automation to the tune of like 95% in SOX, which is operation centers, right? Automating those, triaging incidences, which is fascinating, right? So you're going to continue to see that, but you're not going to see it just at the security level. You're going to see it across the entire enterprise to get after what we just talked about, productivity.
Yes, absolutely. And I think you kind of answered one of the audience questions that we had around quantum computing, so thank you for that.
Yes.
But I think to your point around how AI kind of overlays with quantum and also some of these applications, the ability for adoption across sectors may be varied, like again, depending on how sensitive those sectors are. So healthcare, obviously with disease diagnostics, for sure, but like some other areas, we kind of move into that territory of regulation. I think that's something it's interesting to kind of bring that in right now. And we are obviously seeing a lot of change on that front as well.
We are. And it's like, it's about smart regulation, right? And then we've talked a lot about this, and it's like things that are over, and Alan can talk more about this probably than I can, right? Over-regulated markets like Europe, you're seeing this in Germany, they're having trouble innovating, and they're having trouble driving growth, right? Economic growth, right? So what's, you know, is we look at, we don't want to stifle innovation with overregulation, but let me also say, you got to have checks and balances, right? It is a huge aspect that we're dealing with.
I think there will be a very interesting pivot from what we saw under the Biden administration.
Oh, for sure.
Versus what we're seeing under the new regulations, under the new administration. Alan, how do you play that? Like, where do you see investors could benefit from this switch in stance?
I think number one is the sector I alluded to earlier, which is financials. And I think it's front and center in just the first few weeks of the administration, the focus on financials and the desire to remove some of that regulation. I think there's still going to be some battles fought around what that looks like and in what areas that will really impact financials. But I think net, it's going to be beneficial. And I think it's also going to free up some capital, hopefully, in terms of when you look out to those clients of financial services and the opportunities set there. But the reality is, with rates where they are, I'm always fascinated because people will immediately say rates are so high now. And yet, when you look at it on a historical basis, and the 10-year yield was at 15% in 1982, again, it's not just the regulation side. I think there are other aspects of this. So
that is one conversation we have to have. But like just staying back on the regulation side of this, I think the antitrust space was also very interesting, right? Under the last regulation, we've not seen so much activity in that space. And that's another area to watch with what the new regime kind of brings in. So, okay, let's go back to emerging markets first, and then we'll come back to what we were just talking about. You've clearly said that there are, like Europe, there are comms. Are there any opportunities that you're seeing with regards to emerging markets that we should watch, or how are you thinking about it?
So we are generally positive on the economic story for emerging markets. In equity, it's been a kind of a disappointing story. And we never see the earnings that the companies seem to generate actually flow through to the shareholders. So emerging market equities have been kind of consistently a little sad, for lack of a better term. Some other areas of emerging markets that are more interesting, though, is like Asian high yield emerging markets have been really interesting. Great yields, north of 25%. It's come down a little bit, but some kind of ignored areas of emerging markets have been interesting in both debt and some equity areas, but mainly some really interesting debt stories. And also frontier market debt as another area. So even kind of lower down the economic development scale than emerging markets, but really idiosyncratic, really easy to get good diversification across countries because they're not really related to each other, but great yields.
Absolutely. So, Alan, we were talking about the geographic kind of connection, right, with the whole tariff conversation. How are you looking at positioning across emerging markets?
Well, I think the key is not to just think of it as an index. And to Jay's point about the emerging markets, I think that's where many investors go awry, is that they think of it as one index, but when you look at the index, or at least the largest, China's going to dominate that.
Yes.
So we think of it as looking across the emerging markets, and you really get this tale of two cities when you think about what's going on in China versus, say, India, where you have a growth story that is more services play versus an infrastructure and manufacturing play. We would look more to a country like India, where we think you can actually generate higher growth with fewer regulatory, tariff-related consternations over time. So we think that's a good place to reallocate capital.
Yeah. And also just mindful of where the trade limitations are kind of coming in, right? Like Mexico, Canada, China. That's interesting. Okay, Jay, with tariffs back in the conversation, we are seeing a little bit of a reverse globalization trend of sorts, right? Like, can we call it that for the most part? How do you think investors should think about it, not just from an asset allocation perspective, but also from the returns that corporate balance sheets are generating and like corporate profitability, essentially? Yeah, so look, we do think tariffs are not great from an economic standpoint. I know there's back and forth and people debating, but I think generally tariffs are not fabulous. They're not great for corporate profit margins. They do raise costs. Ask anybody who's in the kind of the steel industry right now or uses steel. Their costs are going to go up with these 25% tariffs. So I think that's a challenge. The other big problem the disconnect I'm seeing is that we're trying to bring manufacturing jobs back, but we're already at very low levels of unemployment. I'm not sure who's going to pick up and do a lot of these manufacturing jobs, particularly as we try and be really strict on immigration. So I think there'll be a challenge here in terms of keeping inflation down, getting the dollar down while raising tariffs. A lot of these things are kind of contradictory, and I don't myself have a clear vision on what the administration's ultimate goal is. I'm pretty certain no one here can.
let me know if you figure that out. I'm sure here.
Yeah. I think the one thing that kind of reminds me is also what Alan was just talking about, right? Like supply chains, it's important to start looking at supply chains of individual companies as to the small and mid caps where there are a lot more locally sourced inputs would be more interesting at this point in time, not just from a cost perspective, but also from a volatility perspective, right?
100%.
So I think it's brought in really interesting kind of thoughts around how you kind of look at companies or corporate profitability. On the capital markets front, last year, I mean, we thought it was going to be the year of the IPOs, but we didn't see much happen. Any thoughts around what this year will entail? Maybe let's start with you, Jay.
Well, we do think that the administration is going to loosen regulations. That should be a positive for opening up the IPO market. But I think one of the challenges, and Emily might be able to speak to it just as well or better, is that a lot of the valuations embedded in the private market valuations are relatively high. And I think there's an open question, in my mind at least, as to whether or not they can actually get the prices they want in the public markets at what they're being carried at.
Yeah, and I think Jay, I think you're absolutely right. And I think what's going to be really interesting, this is going to be a year of acquisitions, right, and mergers, right? It's got to be, because we got to return capital in some way. They got to exit, they got to IPO, or they got to.
I can tell you, my space, we've already started seeing that last half of the year.
Yes.
Like it's like companies are you either build it or you acquire, and it just makes so much more sense to acquire right now.
I'm seeing the same thing over the last 3 weeks. I have had organic and inorganic conversations conversations around that, right? And I definitely think this is going to be a big year for that, particularly around the corporates and the strategics. As soon as that window opens for them, they're going to pounce, right? They were hungry for it last year. They're even more hungry for it this year.
But explain this to me, like with rates where they are, how do you kind of, and that was a challenge last year too, right? Like how do you circle in that argument of whether how you deploy capital essentially?
Again, it goes back to being thoughtful, right? So for me, it's always about doing your due diligence and being incredibly thoughtful about how you're spending and where you're investing, right? But I think the bottom line is making sure you're both investing and spending in as terms of acquisitions. Where does it align with your strategy, right? Does it get you your business outcomes? Are you serving your end users, right? That is critical. And I don't know, Jay, I don't know if you guys have thoughts on that, but
we think the level of interest rates actually forces the CapEx and the M&A side to be more distinctive, more disciplined.
Yeah,
absolutely.
And so it's really got to hit those targets, really got to hit those synergy levels to actually be worthwhile. So no corporate CEO gets to go out and build their own castle anymore. It's got to go to the
But at the same time, there's so much cash on the balance sheet that eventually it needs to be redeployed. So yes, you may be able to generate net real yield right now, but at a certain point in time, those same executives are going to say, we're not running a money market fund. And so I think that's also going to incent them to go out and do some of these deals.
Yeah, for sure, absolutely.
So we're pretty much out of time, but I'm not going to let this panel go without this one last question. And Emily, that's for you.
Okay.
So AI ML has been like the most widely abused term over the last couple of years. And I think the challenge is that we've seen so many companies come in and claim that they are AI companies that it's kind of
most companies. Most
exactly.
companies.
I don't want to say that, but yeah. So and you do this day in and day out. So what is the advice that you can give to our audience about how do you kind of screen through and how do you make sure that the company is actually an AI company versus let's call it an AI lipstick company?
Yeah, that sounds good. First, it comes down to trust. Like, how much do you trust the team? You're ultimately investing in people, right? And you're investing in their ability to create a collaborative relationship with you until they exit, right? And as we've seen, sometimes exits take longer. I think the other thing that I always do is, can you show me a demo? Not just a demo that's hard-coded and pre-recorded, right? Can you show me a demo that is live? And can you actually let me get into your system and use my own data? Right? If they can do all that and you do your technical diligence, you're in good shape, right? If they can't answer those questions and tell you about the architecture and the RAG and this and that, you got big problems.
Yeah, I completely agree with that. Like, we've heard a lot of conversation where companies are using automation, like plain script hard coding and calling themselves AI. So I think this is one tale of caution that everyone, if you can take back from this room, is like, just do your due diligence around. This is so thank you so much. You've been a fantastic patient audience. And thank you so much to our panelists to kind of